Life. It's an incredible journey full of possibilities, isn't it? But let's be honest, it's also packed with uncertainties. From the moment we wake up, there are potential bumps, challenges, even losses lurking around pretty much every corner. It genuinely makes you wonder, can we ever truly escape risk? Well, today on the deep dive, we're diving into that very question. Or, more precisely, we're exploring how we strategically deal with the inevitable presence of risk. Whether it's personal decisions, ambitious professional ventures, or large scale business operations. Our topic for this deep dive is risk and mitigation. Our mission today is to really unpack the fundamental concept of risk, understand why it's not something we can ever completely eliminate, no matter how hard we try. And then we'll explore four absolutely crucial strategies: risk avoidance, risk reduction, risk retention, and risk transfer that basically empower us to manage it effectively. Before we dive deeper, a quick reminder that this deep dive is based on material from Farhat lectures. All content, examples, and explanations discussed here are derived from the comprehensive accounting resources at farhatlectures.com. Whether you're an accounting student, CPA candidate, or professional, make sure to visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. Special thanks to Professor Farhat for providing this valuable material. So let's start at the beginning. When we talk about risk in this context, what are we really defining? It's not just the big headline-grabbing disasters, right?
Exactly. No, it's much broader. Risk is, well, it's a fundamental aspect of existence, really. In its simplest form, it's present in any situation where there's a chance, probability, of experiencing some kind of loss. And that scope is incredibly broad. Think about a company. If their valuable data resides online, there's an inherent risk. Data breach, cyber attack.
Right. Very common these days.
Absolutely. Or if you invest in the stock market, you immediately expose yourself to financial risk, the possibility of losing capital. But it's even more pervasive than that. There's physical risk just walking down the street. You could slip and fall.
Sure.
And then there are environmental factors like earthquakes or hurricanes. Those pose significant risks too. And what's often overlooked is that while risk is inherent, the degree of your exposure, how involved you are, directly increases the probability of that risk actually happening.
More exposure, more chance of loss.
Precisely.
Okay, so if risk is this inherent omnipresent thing, like you said, it's just everywhere, can we ever truly eliminate it? Is the ultimate goal simply to get rid of it entirely?
That's a really critical distinction. The core objective of risk mitigation is emphatically not to eradicate risk completely. It's often impossible, or at the very least highly impractical, to reduce risk down to absolute zero.
Yeah.
In fact, as the source material humorously points out, the only time you truly encounter zero risk is, well...
when you're not around anymore.
Exactly.
Yeah.
So instead, the aim is to strategically manage risk, to bring it down from a high or medium level down to as low as reasonably possible. See, mitigation involves strategically picking from different methods to manage specific risks. For a business, this strategic choice is all about minimizing catastrophic financial losses, protecting assets.
Makes sense.
And for an individual, it's about safeguarding your well-being, your finances, your future. It's really about proactive management. It's not just avoiding everything that carries a potential downside, because often those potential downsides come attached to potential opportunities.
That's such an important perspective. It's like, you can't just live locked in your home thinking you're perfectly safe. There's always some risk, even though going stir crazy maybe, as the source amusingly suggests.
Right.
It's really about finding that dynamic balance. Acknowledging risk, maybe even facing it, but doing so with a clear strategic plan to mitigate its potential impact. Okay, before we get into those specific methods, those four strategies, I think it's vital to ask, how do we even begin to decide which strategy to use? What factors really guide that choice?
That's precisely the right question, because the choice really hinges on two crucial factors. The first one is frequency.
Frequency.
Yeah. This is simply how often a specific risk is likely to occur. It's probability. Think of it maybe as a percentage. Are we talking a 10% chance of this happening, or is it more like a 99% chance? How common is it? The second factor is severity.
Severity.
Right. This measures the potential damage. The impact if the risk does materialize. Is the potential loss $1,000, or are we looking at $1 million? What's the scale of the damage? And what's fascinating here, what's really key, is how understanding both the frequency and the severity of a particular risk informs the most appropriate control method.
Okay.
You don't just react. You assess both dimensions, and then you choose your strategy intentionally.
All right, let's get into those 4 core risk control methods then. Let's make this tangible. Maybe imagine someone listening, let's call her Sarah, is starting an exciting new online business, maybe selling handcrafted goods. We can explore how she might apply each of these strategies. First up is risk avoidance. On the surface, this sounds like the easiest one. Just don't do it.
It does sound straightforward, and conceptually it is. Risk avoidance means you just completely steer away from the activity or situation that carries the risk. You make a deliberate choice not to engage at all. Now, you typically choose this when the frequency is HAH and the severity is HI.
Both high. Got it.
Right. This is your sort of catastrophic and almost certain scenario. You pick this when there's really no effective response available, or the risk is just too high to manage effectively without sinking the whole ship, so to speak. But here's the catch. While it seems simple, true risk avoidance often means saying no to potentially significant opportunities.
Okay, so for Sarah's business, let's say making her goods involved handling some really volatile chemicals, high risk of explosions and severe injuries. She might choose to avoid manufacturing entirely.
Makes sense.
Maybe she pivots, curates and resells goods from other safe producers instead. She avoids that specific high-risk activity altogether. And beyond Sarah, we see this when an investor chooses, say, government bonds instead of volatile stocks.
Avoiding market risk.
Or someone deciding not to take up, I don't know, base jumping to avoid obvious serious injury risks. It's taking the activity completely off the table. But what if avoiding the risk isn't really an option? Maybe the activity is central to Sarah's business model, or she doesn't want to miss out on the opportunities. What then?
That's exactly where risk reduction comes in. This is a strategy aimed squarely at lessening, reducing either the severity or the likelihood of the risk occurring. It's crucial to remember it doesn't eliminate the risk entirely, but it makes it much more manageable, either less likely to happen or less damaging if it does. You typically choose this method when the frequency is HEH, BUT, the severity is low W.
High frequency, low severity.
Yes. So something that's pretty likely to happen, but if it does, the damage isn't catastrophic. You want to implement controls to make it less impactful or maybe just less likely. For a business, this often involves putting in robust internal controls.
Perfect. So for Sarah's online business, she has to process customer payments online. Can't avoid that. That carries a high frequency risk, maybe of data breaches or payment fraud attempts.
Right, common issue.
But she can reduce that risk maybe by implementing advanced encrypted payment gateways, regularly updating her cybersecurity software, things like that.
Exactly. She's making the risk less likely or less severe if it does happen.
And in other contexts, this is like a big company implementing internal controls to reduce fraud risk, or homeowners installing smoke detectors to reduce fire damage risk,
Good example.
or even a shop putting up security cameras to deter theft, reducing crime risk. Now, here's where it gets particularly interesting, I think. Sometimes the best strategy isn't avoidance or reduction, but to simply accept the risk and deal with the consequences yourself. This is risk retention.
That's right. Risk retention involves actively accepting the risk and dealing with any fallout internally. It's often called self-insurance, especially in business.
Self-insurance, okay.
And it's frequently chosen when the cost of transferring the risk, like buying insurance, is just too high compared to the risk itself. Or the risk is simply too small to worry about insuring. You typically choose this when the frequency is low, NAD. The severity is low and low. Yes. So it's not likely to happen often, and if it does, it's not a major financial blow. It won't cripple you or the business. And this isn't just passively ignoring it. It's an active, strategic choice to absorb those predictable minor costs yourself.
I can see Sarah doing this. Let's say a tiny percentage of her artisanal products arrive with minor cosmetic flaws. Easily fixable, low frequency, low severity. She might just budget a small amount for replacements or repairs out of pocket.
Right, rather than paying for complex insurance.
Exactly. She's retaining that minor risk. And in our personal lives, this is like choosing to pay for minor car scratches yourself instead of filing an insurance claim and risking higher premiums.
Yeah, happens all the time.
Or just accepting the risk of minor wear and tear on appliances without buying those extended warranties. You just deal with it if it breaks. And finally, the fourth option. This is the powerful one of passing the risk onto someone else entirely. Risk transfer.
Indeed. Risk transfer involves shifting the financial burden of a risk to another party. Most commonly, this is done by buying insurance. That's the classic example.
Insurance, yeah.
But it can also be done through legal agreements, like indemnification clauses in contracts. Basically, instead of self-insuring, you're buying protection from a third party. You choose this method when the frequency is LOBQT, the severity is high GH.
Low frequency, high severity, the big potential hits.
Exactly. In these cases, even if an event is pretty unlikely to happen, the potential damage or financial impact is so severe, potentially catastrophic, that you absolutely do not want to bear that cost yourself. You want to offload that possibility of a huge loss.
Okay, so for Sarah's artisanal goods business, while minor product defects are low severity, a severe injury to a customer caused by one of her products, that could lead to a massive lawsuit. That's a low frequency but very high severity risk.
Definitely.
So she absolutely needs product liability insurance to transfer that specific risk.
Yes, crucially for her.
Beyond her, a classic example is a construction contractor. They transfer the risk of major accidents on a job site to an insurance company with a comprehensive policy.
Can't afford to retain that one.
Or when you rent a car and get that insurance package, you're transferring the risk of damage or theft to the rental company.
Good point.
And maybe the most impactful one for many of us, buying medical insurance, covering potentially financially devastating medical emergencies. You just wouldn't want to retain that kind of risk yourself.
Absolutely not. The severity is just too high.
Okay, to really tie this all together, make sure these concepts are super clear, let's quickly apply all four methods to something most of us deal with: owning a car.
Yeah, this is a perfect quick recap. So if you choose not to own a car because of all the risks, accidents, theft, costs, and you rely on public transport instead.
That's risk avoidance.
Exactly. You've completely steered clear of the whole activity and its risks. Now, if you do own a car, but you're worried about theft, you might install a really good alarm system, maybe a GPS tracker.
You haven't eliminated the risk.
No, but you've actively taken steps to reduce its likelihood, or maybe the impact if it does get stolen. That's risk reduction. Okay, risk retention. Your car gets a minor scratch, small dent from a shopping cart in the parking lot.
Annoying, but minor.
Right. You decide, I'll just pay for that out of my own pocket. You don't file an insurance claim.
You're accepting that minor, low severity, low frequency risk yourself.
Precisely. Rather than involving a third party. And finally, risk transfer. You purchase comprehensive car insurance.
The big one.
Yep. You are shifting the financial burden of major accidents, serious damage, significant theft, all that potentially catastrophic stuff over to the insurance company.
They bear the brunt of that big financial loss, not you.
That's the essence of risk transfer in this case.
That car example really does perfectly illustrate how these strategies aren't mutually exclusive. We often use them in combination without even thinking about it. Okay, to really cement this, let's do a quick challenge, pulling from the source material. In the context of risk management, what does transferring a risk typically involve? Is it A, taking action to completely avoid the risk, B, implementing measures to reduce the risk's impact, C, accepting the risk and its consequences internally, or D, sharing the risk with another party, such as an insurance company?
Okay, let's break it down. Option A, completely avoiding, well, that's clearly risk avoidance.
Right.
Option B, implementing measures to reduce impact. That's risk reduction.
Makes sense.
Option C, accepting the risk internally. That's our definition of risk retention or self-insurance.
Yep.
So based on everything we've discussed and what's in the source material, the correct answer for transferring risk has to be option D, sharing the risk with another party, especially through insurance.
Perfect. And there you have it, risk. It truly is an unavoidable part of existence, isn't it? But as we've explored today, by understanding and strategically applying these four core control methods, avoidance, reduction, retention, and transfer, we can actually proactively manage it. It's about being prepared, not paralyzed by the what-ifs, making deliberate choices.
Yeah, and if we connect this to the bigger picture, these principles, they extend so far beyond just business or finance or accounting. They apply to almost every decision you make in your daily life, managing personal finances, health choices, even how you approach career changes, or heck, even new relationships.
That's true.
Understanding these concepts encourages, well, it encourages a crucial form of critical thinking. It helps you make more informed, calculated decisions and navigate life's inevitable uncertainties with, honestly, significantly greater confidence. It kind of transforms you from just being a passive recipient of whatever happens to being an active manager of the possibilities and the risks involved.
So, my challenge to you, our listener, is this. How do you implicitly use these risk mitigation strategies in your daily life already, maybe without even realizing it? Think about your commute, your investments, your health habits. Where are you avoiding, reducing, retaining, or transferring risk? And now that you know them explicitly, where might you apply them more intentionally to protect yourself, your family, or maybe that next big venture you're thinking about? Investing in this knowledge isn't just for exams or letters after your name. It's really about building resilience and strategic foresight in what is, let's face it, a wonderfully uncertain world. We really hope this deep dive has given you some valuable insights into managing risk. For additional resources, practice questions, video lectures to deepen your understanding of this topic and many others, whether you're prepping for the CPA exam, taking accounting courses, or pursuing other professional certifications, definitely make sure to visit farhatlectures.com. And again, a huge thank you to Professor Farhat for providing such valuable material for us to discuss today.